One of the terminology items that we use a lot is DTI, debt to income ratio, and how we figure those things out. There are two parts to the debt to income ratio. There's what we call the front end or the back end. So the front end is your actual monthly payment, your principal, interest, taxes, and insurances. That's going to be your first ratio. There are always two ratios, except for VA, but we won't get into that. So there's always two ratios. The back end ratio would be all of your debts included. Any car payments, any student loans, any credit cards, in addition to your new projected monthly payment. And that gives us our back end ratio. Generally, we can go up to a 46 on a front and a 50 on the back. So keep in mind, if you're going all the way up to a 46 on the front, that means you can't have much debt on the back. Probably no car payments, minor student loans, and a few, credit cards, that kind of thing, or a very small car payment. So if you do have a larger car payment, then we need to take a look at lowering what we call the front end or your housing payment. So that's how we put the puzzle together. So we want to take a look at that based on maybe a pay stub. And I'll show you how we figure that out, and then I'll show you what goes into your front end DTI, or debt to income. So on your pay stub, when we receive a pay stub and we look at it, it has to have your name, your address, at least the last four of your social with the X's in front and all of that. It needs to have the date of when it goes through and when it pays you. It needs to tell us whether you get an hourly rate or it gets a salary, and it will show that. It will say 40 hours and it'll go straight to a straight amount. And if we get 4 paychecks, then we know they're all the same and it's a salaried amount. If it says 40 at 22, then that means you get paid $22 an hour for 40 hours a week. When we get those kind of pay stubs, sometimes we have to dig a little deeper, because we can't just say, okay, you get paid $22 an hour and you work 40 hours a week. We have to make sure you work 40 hours a week. Most people work 40, 38, 39, whatever, something like that. So we have to actually average that out. But the pay stub we're going to look at is basically 40 hours at $720 a week. So that's going to be your monthly income. It does show an overtime amount, but a lot of times we don't use the overtime, because if you can't prove you get it for 2 years consistently, we can't use it. So that is something that we don't always look at right away to give you a pre-approval. We just look at your base income, unless you do get a lot of overtime and we can verify it for 2 years. So when we're looking at that, you'll go down to the bottom of the pay stub and it'll show gross earnings, deductions, and net earnings. So over to the right, it usually tells you your debt, your deductions, your taxes, your Social Security, 401k, insurances, that kind of thing. So then when we get down to the bottom, we have your gross earnings and your net earnings. When we are figuring debt to income, we are looking at your gross earnings. So a lot of times everybody's like, great, that makes me qualify for more. Keep in mind, that's not the money you're going to get on your pay stub or on your paycheck when you get it in. So if you already have a hard time making a $2,000 a month monthly payment based on the income you get, you may not want to go up and increase that payment if you don't think you're going to be able to pay it based on your debt to income with your deductions and all of that. Then when we look at your monthly payment and what goes into that, we're going to look at your principal and interest. Then there's going to be a property tax. We've got $300 up here as a property tax. A lot of times when you're going to buy a house, it may not have homestead on it already. So we have to take into consideration what your actual tax bill is going to be. Sometimes it does have homestead. We can sometimes use that unless you're doing a big jump in the price. Like maybe somebody owned this house for 20 years, and they bought it way back when for $100,000, but you're buying it for $500,000. That's a huge difference in what the taxes are going to be, and we have to make sure that you're going to be able to make that payment with those new taxes. So the property taxes go into it. Your homeowner's insurance, you do have to have homeowner's insurance, and if you're in a flood zone, you'll need flood insurance as well. That doesn't happen as often as obviously always needing your homeowners. And when you're looking at getting homeowners, you have to remember you'll probably need a home inspection as well. We don't require a home inspection. We do an appraisal, but an appraisal is not a home inspection. The home inspection, you'll get what's called a 4-point and a wind mitigation attachment to that. That helps you get a lower amount on your insurance, and most insurance companies won't even write it if you don't have those two items. So that's something that goes into that. The other thing is more than likely, if you put less than 20% down, you're going to have PMI. So we've gone ahead and we've added the PMI here into our little monthly payment breakdown. And then, of course, if you decide to buy a condo or you buy a home in maybe Babcock Ranch or somewhere else that has an HOA fee, you will have to pay that. Now, we do not include that HOA fee in your monthly payment for your payment to us, but we do include it in your debt to income ratio. So that is something that you are required to pay, so we do put that up there. So when you're looking at this particular breakdown, your monthly payment is $2,260. That is what we are going to take with that monthly payment with that pay stub. So let's kind of go back to that pay stub really quick. So when you take that $700 a week, and you multiply it by 52 and you divide it by 12, that comes up with $3,120 a month as monthly income. And that's your gross income, not your net, your gross, before your deductions. So if we were to take this scenario and take the monthly payment of $2,260 and divide it by 3,120 a month, that comes up with a 72.43 front-end ratio. You would not qualify for that home because you don't make enough money for that monthly payment. Now, you could tell me, Dawn, I'm already paying $2,000 a month for rent. Doesn't matter. It would help if you were at like 45 or 46, maybe even 47. We could possibly do something. But when you're at 72, that's a no-go. That means we need to stop, we need to recalculate, and we need to go back and look at what we need to do to get your payment down to get you into something that you qualify for. So those are the things that we look at when we're looking at getting you a pre-approval or telling you what you qualify for. So if you've got any questions on all of this, give me a call. Dawn Hall, Van Dyke Mortgage, 239-789-7561, your lender for life.